The Nikkei just closed lower, and right now, retail traders are reading that headline and thinking this is the beginning of a deeper pullback. They are about to get trapped. What looks like weakness on the surface is actually the final compression before a breakout that could add over 500 points in a matter of sessions. There is one danger zone and one hidden opportunity today. I am Eric from Alpha Market Meridian. Now I will show you both. The structure is as clear as it gets. A textbook continuation pattern with an invalidation level so precise that if it breaks, you will know exactly when to step aside. Stay until the end because I am giving out 3 exact entry and exit levels you can use right now, including the high-risk aggressor play that most channels will not touch. The MY session bias for the Nikkei 225 right now is trending with a compression reload. This is not a fading environment, and it is not a range-bound chop. The daily trend is long, the 4-hour trend is long, and the 60-minute structure shows a healthy flag or pennant coiling just beneath the 62,727 resistance zone. The market is absorbing supply after pushing into territory that is psychologically heavy, above 62,700, and instead of rejecting violently, it is holding within a very tight band. That is a sign of accumulation, not distribution. Write this number down. If the Nikkei breaks and closes below 62,577 on a 60-minute candle, the whole structure shifts. That level is the daily key support and the floor of the current micro-range. Below 62,577, I would step back from longs entirely and reassess for a potential liquidation down to 62,426. But until that break happens, the path of least resistance is higher. The bulls are in control, and the bears have no follow-through. The 0.16% decline is noise, not a signal. Let me say this clearly because this is where most people get confused. When a market is in a strong uptrend on the daily and 4-hour charts, and it pulls back by a fraction of a percent on low momentum, that is not a reversal. That is a rest. The question is whether the rest turns into exhaustion or a springboard. Right now, every piece of technical evidence points to a springboard. Please subscribe MY channel before coming to next. Let me walk you through the charts exactly as I see them on my screens, starting from the top timeframes and working down to the 60-minute execution level, because that is how institutions build their conviction. On the weekly chart, the Nikkei 225 is in a structural uptrend that has been intact for months. The moving averages tell the full story. The 20-week moving average is sloping aggressively higher and price is trading well above it, which tells you the intermediate trend is unbroken and accelerating. The 60-week moving average is also rising, confirming that the longer-term momentum supports this move. And the 200-week, the granddaddy of trend indicators, is far below current price and climbing steadily. This is what we call a perfectly aligned, bullish moving average stack. There is no divergence here, no warning sign from the top time frame. The weekly MACD is in positive territory with the signal line pointing higher, and the histogram bars are expanding again after a brief dip. That expansion signals that momentum is reloading, not dying. Drop down to the daily chart and the picture sharpens. The 20-day moving average is acting like a dynamic trampoline. Every time price has approached it over the last several weeks, buyers have stepped in and launched the market higher. That 20-day is currently sitting around 62,400, which aligns almost perfectly with the second key support level I mentioned at 62,426. The 60-day moving average is below that, also sloping higher, adding a second layer of structural support. The 200-day moving average is way down around 60,500. Which means the market has a massive cushion of trend support before any bearish argument even becomes plausible. The daily MACD shows the fast line above the slow line and both above the zero line, classic trending bullish conditions. Importantly, there is no negative divergence on the daily chart. Price is making higher highs and the MACD histogram is confirming them. That tells me the trend has genuine momentum behind it, not just passive drift. Here is what most traders miss when they look at moving averages. They see price above the averages and think overbought. But in a strong trend, price can ride the upper band of the moving average envelope for weeks. The moving averages are not ceilings, they are trampolines. The 20-day average at 62,400 is not a target to sell into. It is the buyer's reload zone. If price retests that level and holds, it becomes one of the highest probability long entries on the board. Now the 4-hour chart. This is where the tactical picture gets interesting. The 20-period moving average on the 4-hour chart has flattened slightly, which tells you the short-term momentum is pausing, but the 60-period and 200-period averages are both sloping sharply higher beneath current price. This is a classic compression setup. Price is coiling between the 20-period as dynamic resistance and the 60-period as dynamic support, and that coil is going to release. Coils always release. The question is direction, and when the higher timeframe trend is so overwhelmingly bullish, coils tend to resolve in the direction of the trend, not against it. The 4-hour MACD shows the fast line dipping slightly but still above the slow line and still above zero. There is no bearish crossover, just a shallow pullback within a bull cycle. This is the kind of MACD structure that frustrates shorts because it never quite confirms their downside view. On the 60-minute chart, where we execute, the moving averages are a bit more compressed. The 20-period and 60-period averages on the hourly are essentially flat and converging around the 62,650 to 62,700 zone. Price is oscillating around them. The 200-period on the hourly is rising and sits around 62,500, very close to our 62,577 key support. This is not a coincidence. When multiple technical tools cluster around the same level, that level becomes reinforced. It becomes a magnetic zone. The 60-minute MACD is slightly negative, which reflects the micro pullback, but it is curling upward and threatening a bullish crossover. If that crossover triggers while price is above 62,577, it becomes the confirmation signal for the next leg up. Let me give you the exact support and resistance numbers one more time, because these are the levels you need burned into your mind. Key support, 62,577 and below that 62,426.84. Key resistance, 62,727.84 and above that 62,878.34. These are not random numbers. 62,577 marks the base of the current 4-hour range and aligns with a prior breakout point from last week. 62,426 is the structural higher low and aligns with the daily moving average zone I discussed. On the resistance side, 62,727 is the current swing high that the market has tested and respected. 62,878 is the next measured move target based on the range projection if 62,727 breaks clean. And here is where the US dollar to Japanese yen crosslink comes in, and this is critical if you want to understand why the Nikkei behaves the way it does. The Nikkei 225 and US dollar to Japanese yen have a well-established positive correlation. When the yen weakens and dollar yen rises, Japanese exporters benefit because their overseas earnings are worth more when repatriated. Right now, US dollar to Japanese yen is holding above 155, and as long as that level holds, the export bid underpins the Nikkei. But there is a ghost in the system, the Bank of Japan intervention ghost. If US dollar to Japanese yen spikes too aggressively toward 157 or 158, the fear of BOJ intervention increases, and that fear can cause sudden equity volatility. We are not at that point yet, but it is the one macro tail risk that could override the technical bullish structure. I will explain exactly how to manage that risk in the strategy section. Yesterday's session gave us a headline that at first glance reads bearish. Japan stocks lower at close of trade, Nikkei 225 down 0.16%. But the context matters more than the headline. A 0.16% decline after a strong rally is not a reversal. It is a digestion day. The market closed near the highs of the session, not the lows, which tells you buyers were absorbing offers into the close. If this were genuine distribution, you would see a close near the lows with expanding downside volume. That did not happen. Let me connect the macro dots. The Japanese equity rally over the last several months has been driven by multiple engines firing at once. First, corporate governance reforms are unlocking shareholder value at a pace we have not seen in decades. Buybacks, dividend increases, unwinding of cross-shareholdings. Second, the weak yen, which despite BOJ rate hikes remains structurally weak because the interest rate differential between Japan and the US is still enormous. The Bank of Japan may have exited negative rates, but a 0.5% policy rate versus the Fed's 5.25% to 5.5% means the carry trade is alive and well. Third, foreign inflows into Japanese equities have been accelerating. Global allocators who were underweight Japan for years are now scrambling to close that underweight. The cross-asset link between Nikkei and US dollar to Japanese yen is the highest conviction intermarket relationship you can trade. Here is how to read it. If US dollar to Japanese yen rallies and the Nikkei does not follow, that is a warning. It means equity buyers are exhausted and the correlation is breaking down. But if US dollar to Japanese yen rallies and the Nikkei confirms with a breakout above 62,727, that is a synchronized risk-on signal that amplifies the bullish case. Right now, we have the second scenario setting up. US dollar to Japanese yen is bid, and the Nikkei is coiling at resistance. The mutual validation is intact. The BOJ intervention fear is the narrative wildcard. If the Ministry of Finance steps in to buy yen aggressively, US dollar to Japanese yen could drop 200 pips in an hour, and the Nikkei would gap down in sympathy. But here is the nuance that most commentators miss. Intervention-driven yen strength tends to be temporary unless it is coordinated with hawkish BOJ policy action. The BOJ has been cautious, incremental. Unless we get a surprise 25 basis point hike with a hawkish statement, intervention alone is a speed bump, not a trend killer. The Nikkei dip from intervention fear would likely be bought, which creates the Aggressor opportunity one. We'll outline shortly. MY directional lean for the next 1 to 2 weeks remains bullish above 62,577. The invalidation of this thesis is a daily close below 62,426. If that happens, the structural high-low sequence is broken, and I would shift to neutral or cautiously bearish. But until that level is breached, every dip towards support within the uptrend is a potential entry. Let me also touch on the broader risk sentiment picture because the Nikkei does not trade in a vacuum. Global equities, the S&P 500, European indices, are in a liquidity-driven rally. Central bank balance sheets are no longer shrinking at the same pace, and the market is pricing rate cuts later this year. That liquidity tide lifts all boats, and Japanese equities, as a high beta play on global growth, benefit disproportionately. The S&P 500 and Nikkei 225 correlation over the past quarter has been strong, and as long as US equities hold their bid, the Nikkei has a tailwind. Trade setups need to be focused today. Most people will skip this section, but this is where money is made. Keep watching. I am about to give you 3 fully defined strategies with exact triggers, stops, targets, and risk-reward logic. Write these down. Strategy 1, the sniper, conservative. This is the setup for traders who want high probability and are willing to wait for the perfect confirmation. The sniper entry triggers on a decisive 60-minute candle close above 62,727.84. That is the key resistance level I have been drilling. A decisive close means the candle body closes above that level, not just a wick. The confirmation signal is the 60-minute MACD printing a bullish crossover with expanding histogram bars at the time of the breakout. If both conditions are met, you go long. Stop loss goes at 62,550. That is 28 points below the key support at 62,577. The logic is straightforward. If the breakout is real, price should not revisit the range floor. A move back to 62,550 invalidates the breakout and signals a bull trap. Your stop is placed below the level that would prove you wrong. Target 1 is 62,878, the next measured move resistance. That gives you approximately 150 points of upside from the trigger. Risk reward on the first target is roughly 1.7 to 1, which is solid. Target 2 is 63,100. which is the psychological round number extension and aligns with the 127% Fibonacci extension of the prior range. That gives you approximately 372 points of upside, for a risk-reward of over 4 to 1. If target 1 is hit, move your stop to break even and let the runner work toward target 2. What voids the setup? If price approaches 62,727, fails to close above it, and then breaks below 62,577, the setup is dead. Do not force the long if the breakout does not confirm. Patience is what separates snipers from gamblers. Strategy 2, the active trader, standard. This is for traders who want earlier entry and better risk-reward, accepting slightly lower probability. The active trader entry triggers on a pullback to the 62,577 to 62,600 demand zone. You are looking for a 60-minute candle that touches into this zone and shows a clear rejection, a long lower wick or a bullish engulfing candle. The entry is at the close of that rejection candle, not at the low of the wick. Stop loss goes at 62,400, just below the 62,426 support level and the daily 20-period moving average zone. This gives you a stop distance of roughly 180 to 200 points. The reasoning is that a break below 62,426 would break the sequence of higher lows that defines the daily uptrend. You do not want to be long if that happens. Target 1 is 62,727, the range high resistance. That gives you approximately 127 to 150 points of upside, for a risk-reward of roughly 0.7 to 1 on the first tranche. That may not seem exciting, but target 2 is 62,878, and that gives you a blended risk-reward closer to 1.5 to 1. When target 1 is hit, trail your stop to 62,600, locking in profit and giving the trade room to breathe toward target 2. If price breaks 62,727, move the trailing stop to 62,650 and ride the momentum. This setup benefits from the moving average confluence. You are buying into a zone where the daily 20 period and the 60-minute 200 period act as support. Multiple timeframes of buyers are likely to defend that area. The entry condition also aligns with the US dollar to Japanese yen stability. If dollar-yen is above 155 and not crashing, the Nikkei bid should hold. Let me pause here and ask you something. Let us see how aligned we are. Type your Nikkei 225 range. For tomorrow in the comments right now, high and low. I am reading them. I want to see how many of you have 62,577 as your low and 62,878 as your high. Drop those numbers below. Strategy 3, the Aggressor, high risk. This is a countertrend or momentum front-running play, and it is only for traders who know how to lose small and manage risk aggressively. The Aggressor entry triggers if US dollar to Japanese yen spikes sharply on a BOJ intervention headline or a sudden risk-off event, and the Nikkei gaps down to the 62,426 to 62,450 zone within a single 60-minute candle. You are betting that the intervention fear is a liquidity grab and that buyers will step in aggressively at the structural support. The entry trigger is a 60-minute candle that tests 62,426, prints a massive lower wick, and closes back above 62,500, a classic spring pattern. Stop loss is extremely tight at 62,350, just 26 points below the trigger zone. If the market closes below 62,350, the support has failed and you are out immediately. No hesitation. Target 1 is 62,650, a quick 150 to 200 points. Target 2 is 62,727. The risk-reward on this setup can be 5 to 1 or better because the stop is so tight, but the probability is lower. This is a high-risk, high-reward scalp against a news-driven flush, and it only works if you execute with discipline. If the market opens below 62,350, do not enter. The setup is void. If the news is a genuine structural shift, like a coordinated G7 intervention, do not enter. This is a liquidity grab. Play, not a fundamental reversal play. Only take this trade if you understand that a tight stop means you might get stopped out on noise. That is the cost of the high reward. Never risk more than 0.5% on an aggressor setup. Keep your standard risk at 1 to 2% maximum for the conservative and active setups. And always remember, never risk more than 1 to 2% of your account on any single trade, and certainly not on the aggressor. No positions through high-impact news events, especially anything involving the Bank of Japan, the Fed, or US CPI. Stops are non-negotiable. If you cannot honor a stop, you should not be trading leveraged products. Protect your capital first. The setups I give you only work when you manage the downside, but if you take away one thing from this entire breakdown, make it this. The critical level for the next session is 62,577. If the Nikkei holds above that number, the bull trend continues and the breakout towards 62,878 is the path of least resistance. If it breaks below 62,577, the compression structure fails and the market could revisit 62,426. That is the line. That is the invalidation. Everything else is noise. Tomorrow, I am watching the Asia session open and any overnight moves in US dollar to Japanese yen. If dollar yen spikes above 156 overnight, the Nikkei will likely gap higher and the sniper entry at 62,727 could trigger early in the session. If we get BOJ commentary or intervention headlines, the aggressor setup comes into play. Either way, you now have a complete plan, no guessing, no reacting, just executing. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live right now, check the end screen. The correlation between crypto and equities is shifting, and there is a funding rate signal that every trader needs to see. Tap the video on your screen to watch it next. Smash like if this analysis gave you a clear plan for today's session. Subscribe and hit the bell for daily institutional level coverage of 8 key assets. I release these videos every single morning so you walk into the market with a professional blueprint. Comment your Nikkei range for tomorrow, and I will see you in the next one. Trade sharp.